Hi everyone, and welcome to Tuesday. And of course, like every Tuesday, we take a look at the performance of the main board for the New Zealand Stock Exchange. Before I do, remember that this is for educational purposes only. It is what I do when I look at trading, obviously, the New Zealand share market. So any questions that you've got, I'm happy to help. But before that, if you're looking for personalised financial advice, remember you do need to go and talk to your own financial advisor. Right, let's take a look. Okay, so the New Zealand market, it did close last week down. That next little candle that you can see out to the right is a little bit of after hours trading. So if I look up here at the top left, you can see that it's gone up about 0.51% for after hours trading. So I am recording this over the weekend. So it just makes it a lot easier without seeing too much more movement going on. Basically, it looks like we're still in obviously a bit more of a downturn, just looking at the snapshot of that particular chart that we've got on the screen. Let's put my moving averages on, and that to me paints a lot better picture as to exactly what's happening with the market and what we can potentially expect. So you can see here, I've just put the 30-week moving average on, and yes, we're definitely trading under that. So for me, that's an immediate red flag that I will not be looking at taking any new positions in the New Zealand market, simply because when a market is trading, or a share for that matter, is trading below its moving averages, it means that there could be further downside to go. And I don't want to try and, I said earlier about catching falling knives, because that's really what happens when markets are moving below their moving averages. I'm just going to also pop on the 15-week. And I've spoken of this before. These are nothing special. They are just the 2 weekly moving averages that I use. And it's about finding moving averages that you like to use and stick with it, because then you start to learn the patterns of the charts or the share, and you will end up getting good results. But you do need to be consistent, because if you're going to use one moving average to look at one share or indices, and then use a different combination of moving averages on another share or indices, then it's going to paint a completely different picture. For me, it's about staying consistent and using the same moving averages no matter what share or indices I am looking at. So as you can see here, the 15-week moving average, it crossed through the 30-week. So the 15-week moving average is a faster moving average of the two. So it responds a lot more quickly, and it can really sort of help as well to see perhaps how much sort of velocity in that is happening in the markets. And you can see that it crossed through basically towards the end of March this year. And at this stage, it's looking like there could be further potential downside to go in this market. And I've said it before, I'm not into picking tops and bottoms. I'm not into perhaps picking what could happen in the markets or giving any sort of forecasts like that. I purely look at these charts to see exactly what's happening. And so that is what the picture is painting at the moment, is that we're still potentially in a lot of downward pressure. You can see as well, looking at the bottom here, there are a lot of big spikes in these red candles, and that's a lot of sell-off. So what could happen is, if a market starts to rally, you could see people start to take potentially some of those smaller wins and look to get out. Who knows? But for me to actually see any definite signs of recovery, I want to see those moving averages cross through. So here's a good example back here in August last year. You can see that blue line crossed through the red line, and sure, it had already had several weeks of good upward movements. It then had a little bit of consolidation before it rallied again, okay, before we started seeing that fall. So that is the sort of thing that I'm looking for, because there's no level to the top when a market is rising, but if a market's falling, it can go all the way to zero. Now, I'm not saying it would with indices like this, because naturally we're looking at the top 50 companies. The stock exchange would take off any low or non-existing shares that fall outside the parameters for the top 50 companies. So the NZX50 would always be going. But if you're looking at this and it was an individual share can definitely run to zero And I have experienced that in my early career with share trading. Tell you what, it's not nice. So for me at the moment, just sit on the sidelines. Any positions that you do have in the market, by all means, keep them there. I wouldn't be selling them just because the overall main board is still looking like there's further potential downside, because every now and again there is a share that will counter trend what the main board is doing. And that's where for me, it's really important to make sure that I've got my stop losses in place and I review them every week. So if a share is still performing well, I keep moving that stop loss up. It's that stop loss protects me in the market, and it makes sure that if a share has been running strong and it is making me money, that I am going to obviously receive that. I'm never going to sell at a top of a market because I've always got my stop loss running below where the market is at that particular time. So anyway, I hope that's helped. Come back on Thursday. We're actually going to take a look at Spark. Spark is a company that I have with people quite a bit over the last 12 months, and I thought let's revisit it and see how it's been going. So until Thursday, take care.